Hello and welcome all of you to this another edition of Navigate with HSBC. This is our podcast series which talks about various different facets of investment and investment strategy. But this series is slightly different because our guest today is a lady who is not only an investment fund manager, but is also somebody associated with the insurance industry. So that's a very lethal combination, of course. Please join me in welcoming Jyoti Vaswani, Chief Investment Officer of Canara HSBC Life.
Thank you so much, Sharbat, for having me on your show.
I'm sure you know that Navigate with HSBC is one series where we usually look at different elements of investing. And we use this series to talk to an expert who can help us and our customers understand about investing. You've got 3 decades of experience, and I have an interesting question for you to start with. So we get to hear so much about active investing, passive investing, indexing. Why don't you break this down for us? Tell us a bit about what do these things really mean?
Yeah, this indeed is an interesting debate, and it's a global debate. And honestly, my opinion is that both approaches, active and passive, have their own place. Investing is not one size fits all. So there are investors who thrive on, generating alpha and having market-beating returns, and there are investors who are happy with market-linked returns. So that's where the debate of actually active versus passive comes in. And in case of an active fund management, there is a fund manager who actually selects stocks basis research, basis market analysis, market trends, etc., in an effort to try and beat the benchmark returns. The advantage is that if you have a skilled fund manager, they are able to generate that alpha and give you that return, which is over market returns. They also, it is easier for them to respond to changes in the market, quicker response, also to seize opportunities which might come in the market. And these are the things which actually generate the alpha for you in case of active fund management. The only flip side would be that probably the returns are not guaranteed and you could have some underperformance also. In case of passive investment, the advantage is that it is completely transparent and consistent. The fund is mimicking a particular benchmark, so you know that the returns will match the benchmark, subject to a tracking error, of course. But that's the difference between active and passive.
So if I could paraphrase this, you're saying that active investments is often about a strategy. It's about actually going ahead of, let's say, a benchmark, if that's what it does. Whereas passive investing is more about following the benchmark. It basically says, if a broader set of assets is behaving in a particular manner, would we be able to replicate that return over a period of time? I think that's about what this is.
Absolutely.
Great. But active, and from an India context, Jyoti, how active is passive, but how prevalent is passive investing? Has it been there for long? Is it a new phenomena?
So passive investment has always been there, but I think it has picked up more pace in the last few years, I would say. The equity cult in India itself has, changed in the last few years, and it's been, I think, post-COVID, it has gone to a different level of, equity investment in the country. And you also can see that, as a percentage of financial savings, equity investments has really been moving up, and that's a very, very positive sign. So with that, passive investment has also picked up pace. And of course, now with that kind of, money that is going into equity, there are a lot of new things which have evolved, even in the passive space. And now you have enough number of strategies to meet various goals of various customers in terms of whatever their goals for their, financial planning are. You now have actually funds which can match those goals. So that's a very interesting development which has happened over the years.
That's interesting, but I have a range of questions to ask you. I'll go back to what you said earlier when we started this conversation off. You spoke about reliability of passive funds. You also said that active funds have slightly more agility in adjusting itself to what's happening in the marketplace. Talk to us a bit about the reliability piece. When you say reliable, what does it mean? Is there any history that you can share with us in terms of numbers?
You're referring to the active fund management?
No, I'm talking about reliability from a passive point.
No. So in case of passive strategies, what happens is when you are, when an investor is investing in an index, in a fund which is mimicking an index, you exactly know that this index has gone up, so you go up. If the index is coming down, you come down. So there is a lot of predictability in terms of what your returns will be.
Right.
So that is where the reliability is in terms of predictability. Yeah, there could be a minor tracking error, but usually that's where the predictability comes in. In active fund management, while you can, it works very well when you are when you are beating the market and the fund manager is doing well. The only risk could be that sometimes you will underperform the market, because if your calls are taking time to play out, the fund manager calls are taking time to play out, there could be periods of underperformance as well. So those will be a little difficult to predict. So I think it's more about predictability than about reliability is what I would say.
Okay. That's again interesting. So basically, because of the way the strategy goes, the chances are that if the broad market is following a direction, you would know you will be following a similar kind of a direction. Your portfolio would follow similar.
And to the similar extent.
To the similar extent. Jyoti, so more often than not, when we talk about passive investing, indexing and index funds seems to be what comes to our mind, investors' mind in that sense. But I of course understand that there is much more to passive investing than that. So why don't you share a bit with us in terms of what are these different strategies? How do they work?
So over the years, I think passive investment has now evolved significantly, and now we have various kinds of strategies which are built into passive funds. These can, range from market cap weighted funds, equal weighted funds. We have factor funds. We also have thematic funds, sector funds, all kinds of dividend yield funds, multi-factor funds. So there are several funds. So these are actually passive strategies with an active twist. So what happens is that there is an index which tracks a particular market index, but there is some factor applied to it which generates the alpha. So this factor could be like a value, it could be momentum, it could be quality, it could be low volatility, it could be anything which adds that extra alpha, or it can generate that extra alpha in that index return. So today you have index returns plus something which comes because of this factor strategy that we are applying to the this particular market weighted index.
So Jyoti, if I understand this correctly, what you're saying is that standard indexing is just following the index, the way the index is constructed, and just sort of goes that way. What we bring to this is that you do the index part of it. You also look at many other elements which impact investments.
Yes.
And you create, and you bring them together into another index net.
Absolutely.
And then you follow.
Absolutely.
So what happens is, while the overall strategy looks passive, actually you're adding active investment management strategies to that.
Absolutely. And just to give an example, for example, you are, investing in, say, a Nifty, a subset of Nifty 500, but you put a momentum factor to it. So therefore, you are picking up stocks which would have done well in the last 6 to 12 months. If you add one more factor to it, for example, a quality factor to it, then you are also getting the financials and fundamentals of those companies into picture. So therefore, you will then have an index, which is actually an index fund, but it is actually, it is driven by a strategy which is momentum and quality. So it's actually bringing great, combination, which can actually generate returns which are better than the underlying index.
So Jyoti, what you're saying is that within the Nifty 500, which by itself is an index, you then apply multiple factors, like you said, momentum, and you said quality, and you choose a subset of the overall index.
Absolutely.
And hence you're able to then get significant differential from what the index performs like. That obviously is very interesting. Thank you, Jyoti. And like we do every time, please look up to HSBC across the social media handles, and obviously follow us at Navigate with HSBC for more interesting topics like this from here on. Thank you for watching us.
If you're doing retirement planning, you want a mix of stability and growth. So these kind of funds will give you that ideal mix without taking very unduly high risk. You are able to meet your goals, especially because you have a longer term investment horizon.